Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. In addition to those joining us in the boardroom today, today's meeting is open to the public through a live webcast. For anyone watching online, if you would like to view the closed captioning for this meeting, please click on the CC icon located in the lower left corner of the WebEx window. You may also change the layout to one of your choosing by clicking on the layout option on the top right side of your screen. Before we begin with our formal agenda, I would like to extend a welcome to the large contingent of new examiners who have joined us here today. Our examiners do very important work in the field, working to ensure that credit unions protect their members and operate safely and soundly. But they don't often get to see the policymaking process up close. By joining us today, I hope that they will learn a bit more about what it takes to develop a new rule or regulation that they will likely one day work to ensure that credit unions have properly implemented. Second, our examiners sometimes must deal with unforeseen circumstances while on the road. That was certainly the case this week. Currently, we have a team of 7 examiners who watch the weather forecast rapidly change while conducting an examination in Guam. Just days ago, Typhoon Mawar was expected to be a Category 1 event. But events quickly changed and the storm became a Category 4 with winds of up to 140 miles an hour when it passed over Guam 2 days ago. The bad news is that the storm caused considerable damage on the island. The good news is that our team sheltered in place together and none of them have been injured. And we have a team of folks working to get them home safely in the coming days. We will also work together as an agency in the coming weeks and months to address the pressing needs of credit unions and their members in Guam as the recovery efforts continue. That concludes my opening remarks. I now recognize Vice Chairman Hauptman for any comments that he may have.
Yes, thank you. Thank you, Chairman. And it's good to see our award winners yesterday. Like you said, it's one of the best days of the year. Good news, you got public recognition. That's cool. You got your medal, you got a piece of money. Apparently the bad news is you have to sit through one of our meetings, so, if you're an award winner. So our thoughts are with the folks in Guam. I don't know much about these things, but it seems like, you remember Maria in, I believe that was one that hit Puerto Rico?
Yes.
So the storm is terrible, and then the storm ends. Our folks may be able to get home on Saturday. I think it's been one of those situations, a tropical place with no power. The weeks ahead are terrible. It's really hot. There's no power. Not only no AC, you can't even have a fan when there's no power. So I think it's not just our folks who get home. It may be a miserable time.
Agreed.
And I just what I've seen on Twitter, there's credit unions are. It's a nice thing about credit unions. They help each other out. And so there's some relief efforts underway. But it looks like for the folks who actually live in Guam, a pretty miserable few weeks and months ahead, just like what happened in Puerto Rico a few years back.
Absolutely. Thank you. Board Member Hood.
Thank you, Mr. Chairman, and good morning, everyone, and welcome. My thoughts and prayers are also with all of those who are impacted by the horrible weather conditions there in Guam. Yes, our examiners are there, and they are holding steady. But one of the things that I want you all to know that we have a very resilient and a very robust credit union system where our folks can really get there. They're on the trenches when it comes to making sure that those credit unions are still able to provide accessible capital and loans and credit and all those types of things to their member owners that are there in Guam. So hearts and prayers are with them, but do know that we are still trying our level best to make sure those credit unions are able to provide service. Nowhere is it more important than now for us to demonstrate the whole ethos of people helping people. I also want to recognize and welcome our Step 5A examiners. I have met all of you online when I welcomed you with some of the events when you all start. I'd like to talk and welcome you to the industry. And you all, we do not have a robust credit union industry or system without you. You are the future. You're the guiding light of what's going to really help keep America's credit union system safe and sound for its 135 million members for the years to come. So welcome. Also, I'd be remiss if I did not recognize that this is, in fact, Military Appreciation Month, the month of May. So happy that we have so many credit unions that really are supporting those men and women in uniform. I know we have Tony Hernandez here from the Defense Council of Credit Unions. So lots to celebrate as we all go into the Memorial Day weekend. Thank you, Mr. Chairman.
Thank you, Board Member Hood. And that concludes our opening comments. The first item of business on our agenda today is the quarterly board briefing on the Share Insurance Fund's performance. Chief Financial Officer Eugene Sheed will join us at the board table for the presentation. Good morning, Eugene. Please start whenever you are ready.
Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. I'm here to present the 2023 first quarter statistics for the Share Insurance Fund. Before I begin my remarks on Q1 2023, I'd like to take a moment to note that since my last presentation, the NCUA has published and released its annual report for 2022, which can be found on the agency's website. The NCUA's report has again been recognized with a Certificate of Excellence in Accountability Reporting. I want to thank my staff, our partners in the Office of External Affairs and Communications, and other staff in the agency who contribute to make this informative report on the agency's programs, performance, and finances. Slide number 2. This table shows the Share Insurance Fund's revenues and expenses for the first quarter of 2023. For the quarter, the fund recorded net income of nearly $42 million. A few of the highlights I would call to your attention are the following. Total income was $90.9 million for the quarter, primarily the result of investment income from Treasury securities. Quarterly investment income increased 10% over the prior quarter and nearly 50% as compared to the first quarter of 2022. Operating expenses were $57.2 million for the quarter, which was mostly attributable to the overhead transfer rate for agency operating expenses. The provision for insurance loss reserve expense increased by $12.2 million in the quarter. And finally, the AME loss reduction for natural person credit unions and corporate credit unions decreased by $1.1 million and $19.3 million respectively due to favorable changes in estimated future cash flows of assets. Slide 3. This table shows the fund's balance sheet as of March 31st, 2023, compared to the previous quarter. As of March 31, total assets were valued at $21 billion, of which 98% are funds held with the U.S. Treasury in cash, overnight investments, and long-term security Treasury notes. A few of the highlights from this slide are as follows. The fund recognized the capitalization deposit receivable of $210 million this quarter. However, the accounts payable and other liabilities includes a refund of $282 million to credit unions with declining insured shares, resulting in a net capital deposit refund of about $70 million. This reflects the net decline in insured shares during the second half of 2022. Cumulative results of operations increased by $367 million due to a reduction in unrealized losses on investments of $325 million and the $42 million in net income I mentioned in the previous slide. Slide 4. The fund records an insurance program liability comprised of general and specific reserves. This is a contingency to cover anticipated future losses resulting from insured credit union failures. Each quarter, we assess the reserve needs for potential and actual credit union failures to make a reasonable estimate of potential losses. During the first quarter, reserve expense increased by $12.2 million, primarily due to an increase in the general reserve. The reserve balance totaled $198 million, which was comprised of $8.3 million for specific reserves and $189.7 million for general reserves at the end of the quarter. Slide 5. Through the first quarter of 2023, 2 credit union failures incurred a loss to the fund. There was 1 involuntary liquidation without a purchase and assumption and agreement, and 1 assisted merger. The cost of the failures was $1.25 million. Fraud was not identified as a contributing factor to these 2 failures at this time. Slide 6. As of March 31st, 2023, the Share Insurance Fund had over $21 billion in par value invested in Treasury securities with maturities out to 2030. The weighted average life of securities held in the fund is 3 years. The weighted average yield of securities held by the fund increased 17 basis points from last quarter to 1.76%. A significant increase from the prior quarter is that overnights increased from $1.7 billion to $2.4 billion. This reflects the position described last quarter, whereby the investment committee has set a target of $4 billion for overnights to meet potential liquidity needs without having to sell any of the portfolio at a loss. Slide 7. Turning to the equity ratio chart, the equity ratio is updated on a semi-annual basis. As of December 31st, 2022, the equity ratio was 1.30%, an increase of 4 basis points from June 2022, and was calculated using an insured share base of almost $1.7 trillion. The blue line across the chart represents the normal operating level, which was set at 1.33% in December 2022. Slide number 8. The projected equity ratio. The projected equity ratio for June 30th, 2023 is 1.25%, a decrease of 5 basis points from the current equity ratio. The forecasted decline is mostly due to the projected growth in insured shares from December 2022 to June 2023. The projected equity ratio is calculated on the same basis as the actual equity ratio, and that formula and calculation are shown on this slide. The projected decline between the year-end equity ratio of 1.3% and the June 30th projection of 1.25% reflects the historical trend of the June equity ratio typically being lower than the year-end equity ratio because insured share growth is usually more robust in the first half of the year. Slide 9. Turning now to CAMELS data. The first quarter CAMELS data represented on the following 2 slides is current as of March 31st, 2023. This slide shows the percentage of insured shares by CAMELS codes from 2018 through the first quarter of 2023. In the graph, the dark blue represents CAMELS coded 4 or 5, the gray represents CAMELS code 3, and the light blue represents CAMELS code 1 or 2 credit unions and their respective percentages of total insured shares. The table underneath the graph shows the total number of credit unions by their CAMEL code. And to note that the graphic at the upper part is not to scale. During the quarter, the percentage of insured shares at credit unions with CAMELS code 1 and 2 decreased slightly, while the percentage of insured shares at credit unions CAMEL code 3 increased. The percentage of insured shares at credit unions CAMELS coded 4 and 5 remain the same. As depicted in the bottom table, the number of credit unions as of March 31st, 2023 was 4,721, a decrease of 59 credit unions from the prior quarter. Slide 10. This slide compares credit unions' CAMEL scores by asset size. CAMELS coded 4 and 5 credit unions are shown on the left-hand side. CAMEL code 3 credit unions are shown on the right. Looking at the 127 total credit unions that are CAMEL coded 4 and 5 by asset size, most of these credit unions continue to have assets of $100 million or less. For those with assets greater than $100 million, there was no change in the number of CAMELS code 4 and 5 credit unions from December 2022 to March 2023. During the quarter, assets and insured shares for credit unions with CAMELS 4 and 5 remain the same. Now considering the 779 credit unions CAMEL code 3, 96% of these credit unions have assets that are less than $500 million. During this quarter, there was an increase in the number of CAMELS code 3 credit unions with assets from $500 million to $1 billion, as well as an increase in the number of credit unions CAMEL code 3 with assets greater than $1 billion. For credit unions that are CAMEL code 3, insured shares increased from $61.5 billion to $68.2 billion, and assets increased from $71.4 billion to $80 billion. In closing, I will note that the supplemental information provided with this presentation in the back has been updated to include more information on unrealized gains and losses and investment information to help interested parties better understand the operation of the Share Insurance Fund. This concludes my presentation, and I'll be happy to answer your questions.
Thank you, Eugene, for that update on the performance of the Share Insurance Fund during the first quarter. First, I want to congratulate everyone across the NCUA for their contributions to our award-winning 2022 annual report to Congress, especially those who work in the Office of the Chief Financial Officer, the Office of External Affairs and Communications, and the Office of the Chief Economist. As Eugene noted, the NCUA's annual report received the Certificate of Excellence and Accountability Reporting from the Association of Government Accountants, and it's the agency's 6th such award. This track record of excellence underscores the NCUA's successful performance, sound financial management, and commitment to transparency. It also demonstrates the NCUA's commitment to achieving our mission, safeguarding the resources entrusted to us, and maintaining the highest levels of accountability. Thank you all for a job very well done. Now let's turn to the subject at hand. The Share Insurance Fund generally continued to perform well in the first quarter of this year. Investment income continued to increase with the rise in interest rates and the shift in the fund's portfolio to overnight investments, which has fortuitously yielded more income than longer-term investments, something that we don't often see. But I was somewhat surprised in looking at slide 2. While the total income is nearly 50% higher, as you noted, in the first quarter compared to the first quarter of last year, the net income is down $12.5 million compared to a year ago. What's happening there, Eugene?
So thank you, Chairman, for the opportunity to clarify on that. So as you noted, while total income is higher in quarter 1 for 2023 as compared to 22, net income is lower. And so this is attributable to a couple of factors. First, both reserve and operating expenses in quarter 1 2023 were higher than they were in quarter 1 2022. And so that brings down net income.
Sure.
But secondly, there was a reduction in corporate AME loss expenses, which was about $19 million for this quarter, and it was about $43 million in quarter 1 2022. And that helped to improve in 2022 the net income. That concludes my response.
Thank you so much. I appreciate those insights. Let's turn to slide 3 if we could. I see here on slide 3, there we go. I see that the line for accounts payable and other liabilities is up considerably. Compared to last year, this item is more than 10 times larger. Why is that, and should we be concerned?
First, I don't think there, in general, should be a concern. The accounts payable and other liabilities is unusually high for this quarter. This entry primarily consists of the capital deposit refunds that the NCUA returned to credit unions in April, whose insured shares declined between June and December of last year. Because the total system insured shares declined, we wound up returning more capitalization deposit this spring than we collected.
So we're really just seeing a truing up here of where things are in the system.
It's the true up.
It's not because we're seeing more losses or other issues.
Correct.
Okay, great. Thanks for those observations. Let's turn to slide 8. I know that this is the one about the projected equity ratio of being 1.25% at the end of the second quarter. This decline in the equity ratio is typical when we do our projections for the mid-year, as it reflects the expected growth that we have typically in the first half of the year. But what if insured shares grew by less than anticipated? Might we actually see that equity ratio, when the actual one comes out, be higher than 1.25%?
Yes. So if the insured share growth is lower than what was assumed in the forecast, then I would anticipate, everything else being equal, that the June 30th equity ratio would be higher than the projected 1.25%. And this is because the insured shares is the denominator in the equity ratio calculation, and the cumulative results of operations, the numerator, would be covering a relatively smaller base of insured shares.
Great. Let's turn to slide 9. While the projected equity ratio is above the statutory minimum for the fund, it is still below the board-approved normal operating level. Additional, the levels of insured shares and assets in CAMEL's Code 3 credit unions continues to increase, though the number of assets in CAMEL Codes 4 and 5 credit unions appears to remain stable. Could this just be the calm before the storm? I know that we are starting to see downgrades in the liquidity, market sensitivity, and management components of the CAMEL's rating. Nationwide, total household debt is also rising, according to the quarterly report on household debt and credit released by the Federal Reserve Bank of New York. And within the credit union system, we're seeing increases in home equity lines of credit, higher used auto balances, and higher than expected credit card balances for this time of year. Together, these data points suggest to me that the budgets of credit union members are starting to be stressed as consumers continue to manage higher interest rates and inflation. If we continue to see falling CAMEL's component scores within credit unions and further increases in consumer borrowing and delinquencies, what might that generally mean for slide 9 in future quarters and the share insurance fund's reserve needs?
So in terms of the reserves needs, under that sort of a scenario, where various economic and credit union factors that you mentioned weaken, and that would it would anticipate then that would impact or could impact CAMEL scores to make those fall as you'd suggested. Then I generally expect that the reserve needs would increase because the same sort of factors, economic and credit union factors, impact the general reserve needs modeling.
Thank you, Eugene. Credit unions should prepare for an increase in delinquencies and charge-offs in the months ahead. Credit unions should also work with these households to help them navigate through these challenging economic times. Additionally, the NCUA will continue to monitor credit union performance through the examination process, off-site monitoring, and tailored supervision of credit unions experiencing problems. And the NCUA board will continue to watch closely credit union and share insurance fund performance so that we may take any necessary actions to maintain the system's stability and ensure the share insurance fund's strength. Despite all of these looming challenges, the credit union system, and I want to emphasize this, currently remains well capitalized, stable, and well positioned to handle a broad range of economic possibilities. That's thanks to the work of Board Member Hood when he was chairman. We began that work during the pandemic, and we've certainly continued that now. Consumers also should remain confident that their insured share deposits at federally insured credit unions are safe. And there's one more thing that I know for certain, that this board stands united in our resolve to ensure that no one ever loses a penny of insured share deposits at a federally insured credit union. That concludes my remarks. I now recognize the Vice Chairman.
Thank you, Mr. Chairman. I want to start, congratulate you on testimony to Congress last week and your appearance on CNBC. You looked and sounded sharp.
Thank you.
But as you stated on CNBC, we're in good shape, and I appreciate you mentioning that in addition to our share insurance fund, the other thing that's before taxpayers have to pay is the central liquidity facility. Mm-hmm. There is never a bad time to remind credit unions to get your liquidity issues solved now before there's a liquidity crisis. Remember, if you plan for it, it wouldn't be a crisis. I see some trade group people here and lobbyists, or as James Madison called them, citizen petitioners. Please do your job to remind everybody to get connected to the central liquidity facility or something else, because there will be a day when it matters. One other thing I want to mention, it's always a good meeting when we can mention a brand new credit union. Since the last time we met, the April meeting, Generations United Credit Union in New York was chartered. It's a church-based credit union. I want to congratulate their CEO, John Lindsay, and my colleagues at NCUA made this happen. Sam Stallman in Consumer Access, Tom DeSantis, the examiner, and John Flagg, the supervisory examiner, who get them started. We've said it before, new credit unions are the purest form of financial inclusion. If the folks at the United Church of Christ who started this credit union, or the other one, Alpha Kappa Alpha, the sorority, if they were satisfied with the current financial services offerings, they wouldn't have bothered to create this new credit union. So if we are making it 1 minute harder, one more form necessary, we should reevaluate our commitment to financial inclusion. So congratulations to that credit union. Congratulations to the folks at NCUA who got that going. Now to the matter at hand. One thing I noted, your graph went back to 2018 on failures. Mm-hmm. From that moment to now, other than a weird COVID situation, it's been relatively smooth sailing. What's a large amount? Like, what are the bad years? Let's say we go into recession, right? Like, what was, remind me of 2009, 10. What's a large amount? What's a recession level number of failures?
I try to forget that, but yeah, it is an important point.
I was an employee with Lehman Brothers in their final days. I will never forget that time.
Oh, my.
But
Yeah, so just going back to 2018,
Yeah.
you can see that 2018 was where we had resolution of some of the taxi cab related credit unions. And so that, you know, between that point and going back to the Great Recession, was the high water mark. So you can see the losses in a typical year have been relatively low, but for when there's some sort of significant event that's taking place. And you know, off the top of my head, I don't recall what the losses were sort of, because obviously at that time, there were a lot of programs set up. There was the temporary corporate credit union stabilization fund that took on a lot of the losses. I believe that what you would see in the share insurance fund, kind of separate from the corporate credit union program, were losses that were certainly even greater than what we're seeing there in the $2 to $3 billion.
even 21, 2022, the 6 and the 7 right there.
Right.
Okay. Majority of those were fraud related.
Right.
In an economic downturn, we have old school failures. People
Right.
don't pay their bills and the economy craters and they don't pay the mortgages and they fail. This period, God bless it, has not had one of those periods of massive job loss. Again, COVID was a weird situation, but the market was flooded with money. It did give us inflation, but it also kept delinquencies very low. This whole period is low delinquencies. What I'm trying to get at is, again, we're fortunate to be in a time, you know, where we haven't had a lot. Let's
Right.
say we have an off-the-shelf recession like 2001 or the early 1990s. What's that graph look like?
So going back to the kind of that 2000, 2001
Yeah.
time frame, losses were, I believe, in the $1 billion to $2 billion range. So they were significantly higher than what we're seeing on that. And the you know, the equity ratio was impacted considerably.
Okay. Fair enough. I just want to stress, given the bank failures we had earlier this year, the way credit union system is, our fund protects 91% of all assets in the entire system. The equivalent number for the FDIC's fund is about 44%. That's obviously not a knock on any other agency. It's because banks have very massive business accounts. That's the whole reason, right? Normal people don't have $500 million in checking. Businesses do. That's the reason that, again, nobody's ever lost $1 with FDIC insurance either.
Yep.
But it is a different situation where 91% are covered in our fund. And despite the persistent economic uncertainty, we've had 10 Fed rate hikes. It's well capitalized. Do you happen to know, I was trying to do the math just now, but my calculator on my phone only goes to like 10 digits. What is the next decimal place? 1.25. What's the share equity ratio? Do you happen to know?
I do not know.
You think it's, remember, because of the range we operate in these days, 1.2, we're forced by Congress to do a resolution plan. 1.33, we kick money back. So there's not a lot of room here. So, and remember last year we got dangerously close to 1.2. So if I'm watching this, there is a slight difference between 1.24, you know, 5 and 1.254. You know what I mean?
Right.
We'll get to that. Why I'm asking about that later. And again, small credit unions who may not have liquidity options set up. We have one, the central liquidity facility. Congress did not renew the way it was before. You could have an agent. So again, I use every opportunity to say, little credit union in particular, you don't have the access you did when Congress allowed our liquidity facility to be accessed in a different manner. I want to say, so talk to your examiner, talk to your league, talk to your corporate credit union. There are ways to handle a liquidity crunch and still live the fight another day. I want to ask you about, I just have one question for you, Eugene. I went back to 2 years ago. I actually looked on YouTube for our meeting. In June of 2021, we voted on CECL, the methodology for the current expected credit loss. That's something imposed on credit unions by the Financial Accounting Standards Board. At that meeting, and this is why I went back, I wanted the exact language. At that meeting, NCUA's chief accountant in the Office of Examination Insurance stated that Cecil may have long-term benefits to the Share Insurance Fund. As of now, how would you quantify Cecil's benefits to the Share Insurance Fund?
So I think with Cecil becoming effective for most credit unions just on January 1st of 2023, I think there's not been enough direct experience with the data to quantify what the current trends or effects of Cecil will be on the Share Insurance Fund or the industry. Certainly the benefits of Cecil, as noted, and you, I think, are articulating from what you saw in the video back then, would be an increased accuracy in determining credit risk of credit unions and their loan portfolios. And long-term, certainly Cecil should make the credit unions financially stronger, which in turn makes the Share Insurance Fund financially stronger.
Yeah. And again, the phrase quoted by your staff, was that someone who reports to you at that time?
No, it's in
Chief accountant, okay.
Insurance.
The statement was, should have long-term benefits, and I'm aware we're not really in long-term yet. Let's just say 10 years from now. Let's call that long-term. Do you think it might, the fact that Cecil exists versus a world where Cecil didn't exist, do you think it might even be 1 basis point? Like whatever we're at 10 years ago, you think it's 1 basis point more because of Cecil?
So I don't know that I'd be able to specifically quantify it, but again, it's just, as we saw in the losses have been relatively lean the last couple of years. I think the question is there, in more economic uncertain times, are credit unions and their balance sheets stronger because of Cecil, which then would impact the Share Insurance Fund.
Gotcha. I only mentioned because Cecil has considerable costs. Things with considerable costs should have considerable benefits. Anyway, that concludes my remarks. Back to Chairman Harper.
Yeah, and I also think there's a corollary to what you were speaking of, and that is if credit union balance sheets are stronger, we may be able to look at the normal operating level in a different way and have that number be lower, certainly, depending on the policy that the board would set. Yeah, good. There we go. Board Member Hood.
Thank you, Mr. Chairman, and I also share the Vice Chairman's enthusiasm for the new credit union charters that have been granted. And there was one you all last week as well. The Episcopal Church has helped create a credit union there in the Bronx. And I think that was also just laudable. And for those of you who are paying careful attention, the church that helped fund this credit union was Trinity Wall Street, Alexandria Hamilton's church, when he was living in the area at that time. So lots of history there. He was in the room where it happened. But back to the issue at hand about today's insurance fund. Thank you for your presentation, Eugene. Ladies and gentlemen, one of the unique aspects of the National Credit Union Share Insurance Fund is the monthly reporting to the public, which is especially relevant to the credit union owners of the 1% capital deposit. Additionally, the NCUA board has quarterly briefings on the NCUSIF to review and discuss the fund and to build trust and confidence within the credit union community concerning our agency's management of their funds. Today's briefing maintains our commitment to the fiduciary duty we have as NCUA board members. After all, credit union members effectively send 1 cent of every savings dollar of insured shares to the National Credit Union Share Insurance Fund. This briefing is also relevant because it's time to update the public on how our examiners are rating credit unions from a safety and soundness standpoint based on on-site exams. So all of you Step 5A examiners, you too will be contributing to a lot of the discussion that we're having. I can't wait to get you all out in the credit unions. The numbers give a high-level view of how examiners rate the industry individually and overall from a performance and soundness standpoint. After the recent and very public failures in the banking system, in addition to the continued economic uncertainty in the past several months, I am pleased to note that the percent of shares coded 4 and 5 as a percent of all shares is historically low at 0.29% of all shares. While we should remain vigilant, especially seeing the slight increase in the actual number of CAMELS 3, 4, and 5 credit unions, overall, the credit union system remains strong up to this point. Our public financial postings and disclosures and credit union performance highlight the unique character of the cooperative system. a system, you all, that was the basis for rejecting the FDIC premium models in years past and still in use with us today, and designing a uniquely cooperative approach. The credit union system is a unique financial system, and our regulatory and share insurance framework should reflect this. So thank you all, Gene, and all your team do every day to really buttress our share insurance fund. I have a few questions. Can we please turn to slide 14? On slide 14, I see the portfolio's unrealized gain loss reserves or figures. Can you discuss how the NCUA manages the interest rate risk in the portfolio?
Sure, I'd be glad to elaborate on that. The current investment strategy helps us to manage the interest rate risk in the portfolio by following first the three key principles. First principle is safety. We only invest in obligations of the United States government. Second principle for us is liquidity. As the SIF portfolio is structured to have consistent quarterly maturities, so that the portfolio should have sufficient liquidity based on historic and anticipated potential outflows. And last is yield. The strategy tries to maximize long-term earnings for the fund once the safety and liquidity standards have been met. When applying these three principles, the investment committee is utilizing a 10-year ladder, which is temporarily on hold, as I've noted, as the fund is currently building its liquidity due to liquidity strains in the industry. Over the long term, the 10-year ladder produces earning stability for the fund while not taking excessive risk if interest rates change. For the context of interest rate risk, this refers to the current and prospective risks to financial institutions' capital and interest earnings arising from moments of changes in interest rates. This is important to your question since the current strategy produces price volatility that is well within NCUA's expected expectations for how credit unions would manage their interest rate risk.
Great, thank you, Eugene. Now, I'm not asking you to be a clairvoyant, but I do want to ask, if market rates stay at or near their current levels, how long would it take our share insurance fund to eliminate the unrealized market loss in years?
Okay, so to address this question, I'm going to make two assumptions. First, as you note, rates stay unchanged. And second, that there's no additional term investments that we'd be making in the portfolio. We'd be keeping things in overnights. So using those two assumptions, the portfolio, as of the end of the first quarter, unrealized losses should decline by $400 million in the first year, $750 million in 2 years, and about $1 billion over 3 years. For every single last dollar of unrealized loss, if rates all stayed the same, would take until the final maturity in 2023. But as you can see, it would decay pretty quickly.
Very well, thank you for that response. And now I want to look at slide 2, and I know the chairman touched on this, and I want to look at it as well from maybe a different perspective. And that is, we talk about the performance of credit unions being strong overall and nearly $20 million of prior loss expenses recovered. Again, could you talk a little bit more about the $12 million expense added to reserves, just for the record?
Sure. So the $12 million in expenses that was further added is the result of increased probability of failure from credit unions based on the economic modeling that we do for the general reserves. The higher probability of failure is forecasted based on the current model of observable data and macroeconomic conditions to include higher delinquency rates, decrease in the home price index, decrease in cash and short-term investments held by credit unions and similar.
Very well, Eugene. And now can we switch to slide 3, please? And on slide 3, there is a $210.1 million capital deposit receivable. There is a $76 million receivable from the corporate AMEs. These funds are not being invested, is that correct?
So as relates to the $210 million capital deposit receivable, we have since collected that. It was a receivable March 31st. 99% of it's been collected to date. And those funds are not being put into term notes Those are cash that we're collecting right now is going into the overnights. As for the corporate receivable, that'll take longer
Okay.
to collect as the corporate program continues to unwind. Most of those assets right now are subject to legal hold. So as those matters get resolved, then that cash would be collected, and to the extent that that comes into the SIF, if we haven't hit our $4 billion overnight target, we would put it into overnights until we've hit that target.
Very helpful indeed, Eugene. Thank you. And then I'm going to conclude, and that's you all for the last several quarterly updates. I know I've discussed the timing issue and the true up and the options that staff would be considering based on one of the external consultant recommendations. Can you please update the public on what you presented to the board? And I want to applaud you for at least taking that research and presenting information to us, but would love for you to update.
Sure, thank you. So we looked at whether we could first we looked at whether we could accelerate the recognition of the 1% cap deposit. And based on current accounting guidance, it was determined that the just outright recognition, to say instead of recognizing in March like we have this quarter, to just do it in December, everything else being the same, was not permissible. So we then considered some alternate scenarios whereby we could sort of resolve this timing difference between basically the numerator and the denominator in the equity ratio calculation. So there was a working group from staff from my office, examinations and insurance, input from counsel that assessed the feasibility of each of the three options that were presented. The working group concluded that while each of the options would reduce or eliminate the timing difference in the equity ratio in some way, none of those options was really considered optimal. Each of the options would require certain changes, either to law or regulation in order to work, or depending on how they were implemented, impact key business processes, potentially increase audit risk, and have other or potential other unintended consequences. So fixing one issue would just cause, or potentially cause a issue somewhere else. So, kind of, I think one of the conclusions was, is the effort, is the juice worth the squeeze?
The squeeze. Well, I want to just again thank you for providing those three options. I had asked about the research, and you guys certainly took it on. You did it with great diligence, and I appreciate it. And to your point, you're right. None of the findings were optimal or truly would have produced unintended consequences. But the research has been done. Your team has put forth the effort. So thank you, thank you, thank you. I have no further questions, Mr. Chairman.
Thank you, Board Member Hood, and thank you, Eugene. That concludes our discussion of the Share Insurance Fund's quarterly performance. The second item on our agenda today is a proposed rule, Part 721, Charitable Donation Accounts. Justin Anderson, Senior Staff Attorney, Office of General Counsel, will make the presentation, and Rick Mayfield, Senior Capital Market Specialist, Office of Examination Insurance, will join him to answer any questions that we may have. Good morning, Justin. Good morning, Rick. Good to see you both. Please get started when you're ready.
Thank you. Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. Rick and I are here today to present a notice of proposed rulemaking to amend the charitable donations account rule in NCUA's Incidental Powers Regulation, or 12 CFR Part 721. Under Part 721, federal credit unions may only use charitable donation accounts to fund donations to qualified charities. As currently defined, a qualified charity is a charitable organization or other nonprofit entity recognized as exempt from taxation under Section 501c3 of the Internal Revenue Code. This proposed rule would amend this definition of qualified charity by including veterans groups as defined by Section 501c19 of the Internal Revenue Code, meaning, if finalized, this change would allow federal credit unions to use charitable donation accounts to fund donations to veterans groups as they are defined under Section 501c19 of the Internal Revenue Code. This rule also presents several questions to commenters and stakeholders on potential further amendments to the definition of qualified charity. Specifically, this proposed rule asks if there are any other groups or entities under 501c or otherwise that are both nonprofit and organized for a charitable purpose that the board should consider adding as qualified charities for purposes of the charitable donation account rule. This concludes our presentation, and we are happy to answer any questions you may have.
Thank you, Justin, for that brief presentation
Very well.
on the proposed rule to amend the charitable donation account section of the NCUA's incidental powers regulation, and for the work of both you and Rick in bringing this matter before the board today. The proposed rule would allow federal credit unions to better serve America's veterans. And with the Memorial Day holiday upon us, as well as it's being Military Appreciation Month, now is an ideal time for the NCUA board to consider this matter. The current charitable donations account regulation was created nearly a decade ago to allow credit unions to develop charitable giving accounts that could be funded with investments otherwise impermissible for federal credit unions. The current rule requires these funds to go to a qualified charity as defined by the Internal Revenue Code. But the charities that support our nation's veterans, their families, and survivors fall under a different regulation, as you pointed, under the Internal Revenue Code. This left credit unions that wanted to support veteran organizations unable to use the charitable giving accounts for that specific purpose. While nothing prevented credit unions from donating to veterans organizations, the current structure may have ultimately served as a deterrent. Last year, the Defense Credit Union Council, along with the Veterans of Foreign Wars and others, wrote the NCUA a letter encouraging us to increase the number of credit unions that participate in charitable giving and to better serve our nation's veterans. And they requested that the NCUA amend the definition of a qualified charity. Many credit unions, they noted, include members of the armed services within their field of membership and include giving back to the community in their mission. The letter went on to explain that charitable donation accounts provide an excellent tool for federal credit unions to engage in limited investments that would otherwise be prohibited by the Federal Credit Union Act. Because these investments are for the express and primary purpose of funding charitable donations, distributions from the charitable donation account are inherently low risk and financially prudent. To correct the situation and provide a new tool for credit unions to better serve their members, the board today is proposing to add veterans organizations as defined by the Internal Revenue Code to the definition of qualified charity, and a federal credit union may contribute to using a charitable donation account. The board is also asking if there are other groups, entities, or organizations that we should consider adding to the definition of qualified charity to inform future rulemaking in this area. I encourage stakeholders across the system to provide the NCUA with comments on this particular issue. Within the credit union system, we have many credit unions with fields of membership that specialize in serving military branches, military bases, the defense-related organizations, and others. With this proposed rule change, we would allow them to better serve their members and to fulfill their missions. That's good for veterans, good for military families, good for credit union members, good for credit unions, and good for our country. In conclusion, this proposed rule is just one that makes sense, and it fits perfectly within the credit union mission of, as noted earlier, people helping people that underlies the entire system of cooperative credit within the United States. I will strongly vote in favor of this proposal. That concludes my remarks, and I now recognize the Vice Chairman.
Thank you, and thank you, Justin and Rick, for your work on this rule. May is Military Appreciation Month, so it's fitting we're doing this now. I want to congratulate the staff for developing the charitable donation account program back in 2013. Credit unions can obviously only grow through their earnings, and this program provides an innovative way to fund donations to 501c3, that's what we have, without taking dollars away from regular income. But today's vote, like we said, is about adding another IRS organization, 501c19 organizations. Given the makeup of the credit union itself, this change is especially meaningful. Military credit unions represent a significant portion of the system. According to our agency's data, 20% of the 130 million credit union members belong to military credit unions. Although this change applies to all credit unions, it's appropriate to give, obviously, the military credit unions in particular, the ability to take advantage of the charitable donation accounts to support these veterans groups. I want to also thank the staff for addressing my concern that there may be other organizations, as you know, it's 501c3, and it goes down the line. There's a lot of different IRS organizations, IRS tax exempt organizations, C19, C18, all this stuff. So we're not trying to single out anyone for special treatment. If there's any stakeholders out there who have a legit case, to add to that, we encourage them to comment to us. Again, we're not trying to just favor one of these many IRS tax exempt organizations. Also want to thank the Marion County Veterans Honor Guard in Kentucky for helping educate my office over the last 2 years on this issue. With their help, we confirm that the IRS automatically gives 501c19 status to veterans organizations, even if they apply for 501c3. So the veterans group can't even be a 501c3 even if they want to. So this change is to ensure that veterans groups receive all the benefits intended for these organizations. So before, unfortunately, the C19 designation prevented them from being included as recipients. The Marion County Veterans Honor Guard in Kentucky, they put a human face on this whole issue. Just like a lot of veterans organizations across the country, this group provides at zero cost full military burial honors to all veterans who serve honorably in any branch of the service. So they're but one of many organizations that can benefit from these type of charitable donation accounts. I have a couple questions. I see that federal credit unions, at least, using these CDA accounts, charitable donation accounts, have to have the assets in segregated custodial accounts or a special purpose entity. What is the reasoning behind that rule?
So Vice Chairman Huffman, I'll take this question. So this requirement enables federal credit unions to better manage this activity and provides more transparency for supervisory purposes. For example, by having the assets segregated, For example, by having the assets segregated, federal credit unions and examiners can more easily determine compliance with the CDA limits and the required minimum distribution. One point I'd also like to mention, I've often received questions from the industry whether or not a sub-custodial account would work for that separate custodial account. The answer is yes. So they can use a sub-custodial account within a master custodial account for that purpose too. That concludes my answer.
Gotcha. Those sort of things are very important. The whole point is if the organization, like a credit union, somehow falls apart completely, that money is separate. And I know, Rick, you'll appreciate this one. Remember last year's disaster with FTX, the cryptocurrency exchange?
Yes.
Regular people had accounts there and lost money. Do you know who didn't? FTX Japan customers. Do you know why? Because Japan required separate custodial accounts. Nobody there lost the money. The whole disaster did not affect them because of one reason and one reason only. Japan regulations required separate custodial accounts. And also, you mentioned minimum distribution. Could you just walk us through that? How much money are you required to kick out every year on these accounts?
So there's two requirements for the minimum distribution. First of all, they have to distribute at least 51% of the total return of the CDA accounts to at least one or more.
Return is earnings.
Total return. So this is a total return type measurement.
Right.
And then second, the distribution has to happen at least once every 5 years. So there is they can't let this account grow for 10 years and not do any distribution if there's positive returns. So they have to do it at least every 5 years. But if they do it, let's say a year from now, that 5-year clock resets. So it's within any 5-year period. And once they actually do distribution, then that clock resets.
You said total return. What if the investments lose money?
Then they don't have to make a distribution.
Gotcha. Yeah. I have a charitable donation account with my brokerage. Same sort of thing. You have to spend a certain amount each. By the way, my one with probably nation's largest brokerage firm, I'm only allowed to give to 501c3 organizations via that. So that concludes my remarks. Back to Chairman Harper.
Thank you so much. Board Member Hood, you're now recognized.
Great. Thank you, Mr. Chairman, and also thank you, Rick and Justin, for your presentation this morning. I am delighted that we're considering today's proposed rule. If today's proposed rule is adopted, it would add certain veterans organizations as a qualified charity, which means that a federal credit union can contribute to veterans organizations using a charitable donation account. The men and women of the U.S. Armed Forces, whether serving in the Army, the Navy, the Air Force, Marine Corps, Space Force, Coast Guard, or National Guard and Reserve Forces, all of these individuals make big sacrifices for our country. We ask a lot of them, and they need to know that NCUA has their back. I often say that as our men and women in uniform are fighting for our personal freedom, I want to give it my best to fight for their financial freedom. As a regulator, I'm proud to do whatever I can to support that mission in ways both big and small. Additionally, as we've already announced, May is Military Appreciation Month, but we can take the opportunity to express our gratitude to the men and women who serve our nation in uniform. I'd like to share with you a fitting quote from President Dwight D. Eisenhower, who was, of course, a U.S. veteran himself, and of great distinction, might I add.
Sure.
In the first year of his presidency, 70 years ago this year in 1953, President Eisenhower marked Armed Forces Day by noting that, and I quote, "Our fighting forces help to maintain the strength and security of our nation and to provide the power for peace needed in the world. So it is fitting and proper that we devote one day each year to paying special tribute to those whose constancy and courage constitute one of the bulwarks guarding the freedom of this nation and the peace of the free world." I end quote. But you all, that is quite frankly a very lovely sentiment. But I would emphasize that recognizing the service of our military personnel and honoring the debt we owe them is not the work of one day, 1 week, or frankly, 1 month. It is an ongoing commitment. And while today's proposed rule is a small proof of this commitment, it certainly is still a step in the right direction. So for that reason, I will be enthusiastically supporting our proposal. Thank you.
Thank you, Board Member Hood. Vice Chairman Hauptman, is there a motion?
Yes, sir. I move that the board approve proposed rule, Part 721 of NCUA's Rules and Regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. The ayes have it, and let the record show that the motion passes 3-0. I had thought you were going to talk about the new credit unions here today at this point, but if you allow and indulge me for a moment, I too want to add my voice of support for the work of CURE, the region, and all of those involved for getting the new credit union started in New York, as well as the AKA sorority credit union. It is, as you have pointed out and you have made a focus of your work on the board, it's important that we get new credit unions into the system. They're often filling that niche that just is going unprovided. I know that the board will be discussing the chartering process at an upcoming board meeting, and I stand ready to continue working with you on the concept of a provisional charter. Is there anything else you wanted to add here?
No, you're right. I did add in the chartering bit sort of in the middle of my comments, but no, again, just I want to commend the folks at Generations United.
Yep.
Their new CEO and the members of my team, our team that we commended earlier. That is absolutely terrific work.
I agree. I agree. Board Member Hood, anything else on your part?
No.
So, thank you. Before I gavel this out, I also want to thank all of the veterans and those still serving our country here at the NCUA for their service. It is a source of.
No, I was going to say the chairman's awards that we did yesterday.
Yes.
Not my prerogative. I'm not the chairman, but I would like to recommend the folks who got that charter going for one of the chairman's awards next year.
I think that's a terrific idea. As noted earlier, May is National Military Appreciation Month. It also includes Armed Forces Week, Military Spouses Appreciation Day, and Armed Services Day. And of course, it concludes with Memorial Day when we remember those who paid the ultimate sacrifice for our country. It is a source of strength at the NCUA that roughly 1 in 7 of our team members is a current or former member of the U.S. Armed Forces. We are grateful for their service and for that of tens of millions of Americans who have devoted themselves to our country since its founding. Let us also recognize and honor the sacrifices of military families who navigate numerous challenges as they also serve alongside their loved ones. To you all, thank you for your dedication, sacrifices, and selfless service. That concludes my remarks today, and it is the end of our agenda. There being no further business, we are hereby adjourned.